Hey everyone, welcome to the webinar today on arbitrage, a fixed income alternative for a rising rate environment. Excited to get into things today. Feel free to put questions in the chat and we'll get to questions after the webinar. So let's get into it. Arbitrage, it's a fixed income alternative for a rising rate environment. Quick disclaimer for you to read through, and let's kick things off. So I really like this quote by Warren Buffett. In fact, it's my favorite quote he has. Give a man a fish, and you'll feed him for a day. Teach a man to arbitrage, and you will feed him forever. So Warren Buffett, the Oracle of Omaha, known as the greatest investor of all time. It's not even debatable. And a little known fact is that he made his best returns in his career through arbitrage. It's been a strategy he's practiced since the 1950s, way back when he worked for Ben Graham at the Graham-Newman Partnership. And it was perhaps his main strategy when he ran his own hedge fund from 1956 to, I believe, 1967, 68. Arbitrage was his main strategy, which is why he was able to just not only crush the Dow Jones Industrial Average, his benchmark, but to do it with much more consistency. I believe he had positive returns every year and much lower volatility. And that was due to arbitrage powering his hedge fund, and even continues with arbitrage to this day. If you look at Berkshire Hathaway, Warren Buffett talks about his latest foray into merger arbitrage through his Activision investment. So Buffett's a big fan. If you know the world's greatest investor is a fan of arbitrage, then perhaps something that's worthwhile looking into. So I'm glad you're sharing this time with me today. What exactly is arbitrage? It's basically capitalizing on a spread or a price differential between where you can buy an asset and where you can sell it. Simple example is retail arbitrage, where you buy a microwave off Walmart for $50, immediately sell it on Amazon for $55. So you're making that $5 arbitrage spread, or that 10% gross return on that arbitrage investment. So ultimately, arbitrageurs earn a spread between the price that they buy and sell an equivalent asset. So that strategy, the investment strategy that we'll be discussing today, is merger arbitrage, in which an investor capitalizes on the difference between a price where you can buy a takeover stock, such as Activision, which is trading roughly 75, and the price in which a buyer has struck a definitive agreement to buy the company at. Activision, that'd be $95 per share. So you're really looking to earn that spread, which can generally be attained irrespective of what the stock market does or the bond market does. You're just banking on the deal closes, and when the deal closes, you'll get the consideration and the spread will close, and you'll generate the arbitrage return. So how do we get, it's not free money. We're getting compensated for taking on a risk. Like if you're an equity investor, you get compensated for that equity risk premium. If you're investing in corporate bonds, you're getting compensated for that credit default risk. Now with merger arbitrage investment, you get paid as a liquidity provider to earn that merger risk premium. And ultimately what that merger risk premium on average is, it's cash plus a spread of about 3 to 5% on top of that. So in the current market environment, we're seeing low risk arbitrage yields around 5-6%, and high risk ones north of 8%. So there's two main merger arbitrage trades. The first is the all cash consideration. This one's real easy to execute because you're just looking to buy a stock at a discount to the takeover price. There's no short selling involved, no pair trading, nothing of that sort. Where it gets more complicated is when the consideration is either all stock or a mix of stock and cash, because with arbitrage, we're trying to put together a consistent uncorrelated return strategy, and we're trying to earn that spread. So when the consideration consists of either partial shares or all shares from the acquirer's stock, we need to hedge that exposure such that we can earn a set spread. We're not trying to speculate on the direction of markets or the direction of the acquirer's stock. We just want to lock in that spread and earn that spread as the deal closes. So to make that happen, to execute on that, we need to short the acquirer's stock at the share exchange ratio as set out in the merger agreement. So when there's shares offered as part of the consideration, we'll need to short the acquirer's stock accordingly and utilize a pair trader to be able to capture that spread, because ultimately our mission as an arbitrager is to lock in the merger arbitrage spread and earn it upon deal closing, ideally irrespective of, and generate that return irrespective of what stock and bond markets do. Here's a fairly straightforward example. We put on this trade in the Accelerate Arbitrage Fund. It was a good one. One that was, oh, I hear something from Yichin. Yes, the webinar has started. I believe you should be able to hear me. Let me know in the chat if you can't hear me. So continuing on with this example here, it is Meritor, which struck a friendly agreement to be acquired by Cummins in late January this year. You see the blue line, which is Meritor's share price. Pre-deal is trading around 25. When the deal was announced, the consideration was $36.50. And on the first day, the share price traded to roughly $1 discount, or $35 and change. So with that, the spread available was about 3% on a gross basis, the difference between where we could buy Meritor shares and ultimately the consideration. And if we bought the first day at 35 and change, then we generated about 3% over 160 days, or about a 6.5% yield, which is that return on an annualized basis. We like talking about arbitrage yield, and arbitrage yield is comparable to, say, the yield of a bond or the yield of a stock, right? So we talk about it in the same way. So here's straightforward merger arbitrage. It was smooth sailing. This deal didn't have a lot of volatility. And ultimately, you can see that arbitrage spread, the difference between the blue line, the Meritor share price, and the red line, the deal consideration, as the deal progresses over time and ultimately closes in the summer of 2022, that spread will close and the arbitrager will generate the return, recycle the capital into new arbitrage opportunities. So where did the returns come from? I briefly touched on this already. Like, merger arbitragers are getting compensated just as you get compensated in other asset classes, specifically in equities. You're getting compensated. You're taking risk above the risk-free rate to generate that equity risk premium, which is usually about 300 to 400 basis points above cash. Credit investors take the term risk premium, where you take on duration risk, and default risk premium if you're in corporate bonds with the risk that the company doesn't pay you your money back if they default on their debt. So analogous to that, merger arbitrageurs, they earn the merger risk premium, which compensates arbitrageurs for the deal falling apart and losing money. So we're coming in, acting as liquidity providers, granting long-term equity investors in the arbitrage target the opportunity to exit, hopefully at a good profit, and hopefully a good spread to arbitrageurs as well. And that merger risk premium, it's manifested through that spread, that discount to the deal consideration that we earn over the deal cycle. So quick primer on our checklist when we're evaluating a merger arbitrage investment. Because it's a very unique type of investment strategy where it requires a fairly unique and differentiated skill set, meaning financial analysis, legal analysis, tax analysis, and then just M&A experience and knowledge specifically, which just comes with time. So when a deal is first announced, they'll come out with a press release. Typically, the press release mentions what type of deal is it. Is it a definitive agreement, which we like to see, or is it a non-binding letter of intent, or non-binding heads of agreement, or some wishy-washy non-definitive deal, which we can't rely on that. We like to see a definitive agreement first and foremost. Then we look, what's the consideration? What are we getting paid? Is it cash? Is it stock? Is it a mix of cash and stock? And then another disclosure in the press release will be the timing. When do they expect it to close? Is it next quarter? Is it that first half of next year? Is it Q4 of next year? Is it fairly ambiguous timing? Because that is very important. Along with the spread, timing is what determines our annualized return or the yield of the investment. Along with the press release, there'll be an 8K, potentially with more additional information. Sometimes they release an investor presentation. Sometimes both the target and the acquirer will either have a joint press release, or sometimes they have separate press releases that disclose additional information. So definitely check both the target and the acquirer to see if they put out separate press releases. And then we want to look at the target. There's kind of a quick desktop due diligence that we want to look at. Shareholders. Every deal is contingent if it's a merger on a shareholder vote, or if it's a tender offer or takeover bid, then shareholders need to tender their shares. So first off, the thing that we'll notice is there a controlling shareholder? Could they block this deal? Are they supported? Have they signed a lockup agreement? Is that a soft lockup, meaning they can tender to a higher bid, or is it a hard lockup, meaning they cannot tender to a higher bid? So these are important things just off the bat. Do we believe that the target shareholders are supportive, or is that a deal risk of the deal falling apart? Then we do a quick review of the acquirer. If it's an all-cash deal, do they have the money? Very basic stuff here. If they're issuing shares, what percent of their float are they issuing? If it's more than 20%, they will require their shareholders to vote. Now that dramatically increases deal risk, because then it puts their company in play. For example, a deal just this morning, a small cap healthcare deal, the acquirer requires a deal vote, and this morning caught an unsolicited bid at a large premium. Now that's put the deal in jeopardy. So it's worthwhile looking into that and noting that if an acquirer is issuing shares in consideration for the target, whether or not they require a shareholder vote to issue those shares is a big deal when analyzing the transaction. Then looking into sector research, is this a highly cyclical sector? Is it a highly regulated sector like utilities or financials? Cyclical like energy or mining? Is it in a bear market like technology? All important deal considerations in terms of looking for red flags and trying to spot risks of the deal either falling apart or being delayed. Then on the regulatory side, are antitrust approvals required? If so, which countries? There's antitrust regulators in the US, in Canada, in China, in the EU, in the United Kingdom, and then there's other country-specific ones in the European Union. There's Germany and Austria, and then you see Brazil and Mexico. So there's a lot of global antitrust regulators. There's also foreign investment regulators. In the US, you have CFIUS. In Canada, you have Investment Canada, and then China has SAMR, which is kind of foreign investment and antitrust combined into one. And then Australia has their ACCC on the antitrust side, and then they have foreign investment rules. So there's so many different regulatory bodies, and then there's the sector-specific ones. For example, in utilities, you generally require the state public utility commissions to approve these transactions. Then for financials, you typically require the Federal Reserve and FDIC. And it's really important to read when the deal is announced, typically they release the merger agreement, which generally contains the key conditions, the key approvals required, and things such as that. And as the deal progresses, they will release the proxy statement or the proxy circular, which details the background and more information with respect to the timing of the deal. Then we got to check on short borrow if applicable and trading. If it's an all cash deal, relatively simple because we're just buying the target. However, if there's share consideration, we got to number one, look into the short borrow. I recently came across a very attractive mining deal that we wanted to participate in. However, we check on borrow and there's none available. So then we can instantly scratch it off the list, not waste our time on due diligence if it's not practical to put on the spread, given no borrow available to hedge to hedge the share consideration when the acquirer is offering shares. And then lastly, if there is a share consideration, we want to have a pair trader just so we can do the long and the short at the same time to capture that spread. So successful merger arbitrage investing requires a fairly diverse toolkit. Just some general comments on merger arbitrage as an investment strategy, because like really what we're looking to accomplish is we're trying to put together a diversified portfolio that can generate consistent returns without any deal risking too much of your capital, because, and we'll get into this, roughly 5% of M&A deals will fall apart, and it's real tough to know which ones are going to fall apart in advance. And if so, you can probably just do this strategy and retire pretty quickly. Even the best make mistakes, but what we're trying to accomplish is put together a diversified portfolio of trades with these specific characteristics. So number one, attractive annualized return. Merger arbitrage is typically a levered strategy, so the expected yield needs to be higher than your carry costs or your funding costs. Obviously higher than the risk-free rate as well. If it's not, then what are we doing in the first place? We're not going to put on a merger arbitrage deal at 2% when you can buy treasuries for 3.5%. And then if we look at a market implied probability of closing, comparing the upside versus the downside, we need to be confident that the true probability is higher than the implied probability manifested in the spread in the market price. And then an idiosyncratic return, and by that I mean an absolute return of that arbitrage trade that will be generated irrespective of what the stock and bond market does, ideally in a low volatility manner. We had a couple of higher volatility spreads on, whether it be Tenneco or Twitter. Those are sort of drama-filled situations. It justified the volatility because the yields were very high. However, you don't want a low-yielding deal with tremendous volatility because that just introduces beta to your return stream and causes a lot of stress. Here's one of my favorite slides, if not my favorite slide, after the Buffett quote slide, of course, because that's my number one. This data is per JP Morgan. If you want to take a look at it, it's in their quarterly JP Morgan Asset Management Guide to Alternatives. A simple Google search and you'll come up with it. I reformatted the chart just to make it a bit more clear. So what this shows is if you look at all these alternative investment strategies and also global bonds and global equity, your traditional asset classes, there's no strategy here that performs as consistently as merger arbitrage, which has generated positive returns each and every year. For 2022, it's close, we'll see. However, its consistency is unmatched in investing. In addition to that, if we look at risk-adjusted returns, if you look at, a 4.8% return, nothing to write home about. In fact, global equities did 8.5% annualized over the same period. End of story, right? No, far from it. Whenever we're analyzing an investment strategy and asset class, we want to look at risk-adjusted returns or the return per unit of risk, because we could always lever up a strategy. For example, merger arbitrage generated 4.8% annualized with a standard deviation, a risk of just 4.7%. So a return per unit of risk of north of 1. If we look at global equities, they generated an 8.5% return. Sure, that's higher. However, investors needed to take almost 4 times as much risk with global equities, given its standard deviation of nearly 18%, leading to a return per unit of risk of just 0.5. So comparatively, merger arbitrage doubled the risk-adjusted performance of global equities and handily outperformed bonds, both on an absolute return basis and on a risk-adjusted basis. Versus bonds, merger arbitrage had high returns with lower risk. Pretty amazing, right? I think so. This is the slide if you're looking and wondering what to do about bonds. Man, bonds have been smoked lately. I ran into a lot of investors 18 months ago buying the 10-year treasury note at 1% yield. And I said, why are you buying that at 1%? And they told me, look, those bonds are there to protect our stocks when we enter a bear market. And boy, that thesis turned out completely wrong. If you look at TLT and it's down 20-something% in a supposedly safe asset, bonds are having a rough go of it in a rising rate environment. So if we look at this chart here, arbitrage in the blue line versus the global bond index, the red line, it's not tough to see. Bonds have been smoked just on an absolute basis, but on a relative basis, arbitrage is just crushed bonds, more consistent returns, lower volatility, and obviously significantly better returns. Over a decade, bonds almost no return, arbitrage up nearly 80%. There's a couple of reasons, a couple of main advantages that arbitrage has for a fixed income alternative. So number one, very low duration. The average merger arbitrage is 4 to 6 months. If you look at the bond index, the average duration is 6 to 7 years. It's light years apart in terms of duration. So way less duration risk. Granted, if you think bonds are going to have a big rally as duration works and rates come down, by all means, lever long bonds. But what I'm trying to convince you of is diversifying your portfolio, specifically your fixed income, if you want a more consistent, better performing, high risk adjusted returns for your portfolio. Then lastly, tax efficiency. Arbitrage, you generate returns via capital gains. Bonds, you generate returns via interest income. So for those with taxable accounts, capital gains are generally taxed at 50% of the rate as interest income. That's not tax advice. Consult your tax professional. Oh, last point, as you can see on the header here, merger arbitrage has outperformed bonds handily, but with 30% lower volatility. Another awesome slide here. So there's been 5 bouts of rate increases over the past decade. Start in 2013 when the 10-year rose 130 basis points. Bonds fell by 2.6%. Arbitrage over that period went up 4.7%. Then go to 2015. 10-year barely ticked up 10 basis points. Bonds fell over 3%. Arbitrage up over 3%. 2018, 10-year ticked up a bit. Bonds down 1.2. Arbitrage up 3.3. 2021, a 10-year up almost 1%. Bonds down nearly 5%. Arbitrage up more than 10%. Then the big one, the big kahuna, 2022, bonds down 20% as the 10 years up significantly. And arbitrage hanging in there. So in a rising rate environment, bonds struggle while arbitrage can outperform. Arbitrage adds an asset class, so it's gone up 5-fold over the last 10 years. Now $110 billion asset class that is assets under management globally for arbitrage funds. And it's really become a default allocation in institutional portfolios, family offices, endowments, pension funds. If you look at their portfolio, guarantee you'll see arbitrage in there. we're seeing it more often than not held in investment advisor portfolios as well, as they see the benefits to investor portfolios. So it's certainly an area that is experiencing significant growth. Just, the numbers don't lie, and the numbers are great. So when putting together a merger arbitrage portfolio, there's a few things that we look at that differentiates merger arbitrage portfolios. So one thing to note is when comparing merger arbitrage funds, the investable universe isn't all that big. There's generally 6 to 90 deals outstanding at any one time. There's never been deals running out. There's always something to do. I've done this since 2009, and I've never come across a time when there were no deals. There's always dozens and dozens of merger arbitrages to invest in. So number one, security selection. Then number two, position sizing. We generally like to cap our potential risk and losses. And then lastly, leverage. Some firms lever this strategy significantly. Some run it unleveraged. Some apply a prudent amount of leverage. And ultimately, merger arbitrage can be executed on a sort of quantamental basis. It requires fundamental analysis, but also executing and managing in a systematic way. So we really look at the execution and portfolio construction of merger arbitrage based on these three key factors: security selection, which arbitrage investments does the fund have, position sizing, how diversified is this fund, and lastly, leverage. Is it 1.5 times leverage? Is it 3x leverage? What can we expect from merger arbitrage in the current market environment? Well, this is a very interesting graph. If we look at the average merger arbitrage in the blue line compared to the average junk bond yield in the red line, pre-COVID, they generally offer the same yields. They traded in line with each other. Then COVID hit, and since then, merger arbitrage yields have been significantly higher than junk bond yields. In fact, currently, merger arbitrage average yield is about 12%, while the average junk bond yield is 9%. So about a 300 basis point spread between merger arbitrage and junk bond. The other key factor is duration. Junk bond funds tend to have duration of more than 6 years. The average merger arbitrage is about 3 months or a quarter of a year. And then lastly, you can generally get a tax advantage in arbitrage because you're generating yield via capital gains. In bonds, it's interest income. I wanted to touch on the risks. Note that merger arbitrage is a low risk strategy. Depending obviously on how much leverage is applied, you can apply leverage to anything and make it high risk. But a no leverage or moderately leveraged arbitrage strategy is low risk. Historically, and our data goes back over a decade, so thousands and thousands of deals. 94% of them close successfully, and roughly 6% break over time. Now, conversely, 5% over time exhibit either bidding war or an increased consideration that generally make up for the broken deals. So I think if you're executing on a merger arbitrage portfolio and have a diversified merger arbitrage portfolio, you're always going to have a deal break in there each year, but hopefully offsetting that, you have a competitive deal situation with two firms competing against each other to pay higher and higher prices for the target, and you get to experience that bump in price. So to wrap things up here today, merger arbitrage can represent an attractive allocation as a fixed income alternative. It's a low risk strategy. It's one of the consistent, if not the most consistent performing strategy out there. It doesn't generate positive returns every day, every month, or every year. However, it is positive in most years, more so than basically any other investment strategy aside from cash. So it does provide that stable, low risk profile. It is generally uncorrelated, so it's known as an absolute strategy where it's not really affected by the equity or bond bear markets. And then lastly, it can be tax efficient for certain types of investors because you're generating yield by capital gains and not interest income. Quick note on Accelerate, we offer a number of alternative investment solutions, including an arbitrage ETF, ticker symbols ARB, on the TSX. Been doing this a long time, been running an arbitrage mandate since 2009, so 6+ decades of experience with our team. This is our ARB ETF, pays out a 3% distribution, compounded double-digit annually, about 13% annualized since it launched, and generally uncorrelated with both stocks and bonds because we're seeking to generate consistent returns irrespective of market direction in a low risk manner. And I just, before I let you go, or before I get to questions, I wanted to leave you with one more thing. Now, this is arbitrage versus the bond index in these columns. And basically, on every characteristic, arbitrage has beaten bonds. Annualized return, arbitrage has beaten bonds by nearly 17% per year. Total return since inception, arbitrage has beaten bonds by nearly 45%. A year-to-date return beating bonds by more than 10%. Distribution yield higher by 20 basis points. After-tax distribution yield higher by 90 basis points. Underlying portfolio yield higher by nearly 600 basis points. Same risk rating. Duration lower by about 96%, 0.3 years versus 7.4 years. And then that distribution is tax efficient. So arbitrage offers a myriad of benefits over bonds in a diversified portfolio. That's it for me. If you want this presentation, send me an email. Happy to open up the floor for questions, if you should have any. So Georgie says, can we obtain the presentation after? Yes. Here's my email. Send me an email. I will send you the presentation. Any other questions on arbitrage? If you want to look into some of Buffett's old arbitrage trades, a good one was Sanborn Maps. That's one of my favorite ones. He did a really cool one on cocoa beans with Ben Graham back in the day. And another great arbitrage that turned into a long-term hold was Berkshire Hathaway. That position for Buffett in his hedge fund actually started out as an activist arbitrage play, and he decided to hold on to it and take it over when the tender offer price was not high enough to his liking. I think the company shortchanged him by 25 cents. So he decided to say, forget about them and take it over instead. All right. Well, thank you, everyone. Hope you enjoyed the webinar. Reach out if you have any questions or if you'd like to see the presentation. Hope you have a great day. Bye, everybody.